The greatest investor in history is refusing to invest. For more than 3 years, Warren Buffett's Berkshire Hathaway has been selling stocks, not buying them. Apple, Bank of America, Amazon, gone, or dramatically reduced. And the cash pile that replaced them, $397 billion. Not sitting in a bank account, sitting in US Treasury bills, earning interest, and waiting. The question the entire financial world is asking is simple. What does he know that we don't? This is AxisShift. Warren Buffett is not a normal investor. He is the man who turned $10,000 into $700 billion. The man whose annual letters are studied like scripture by professional fund managers worldwide. The man who has navigated every major market crash of the last 6 decades and emerged stronger every time. When Warren Buffett stops buying, the world pays attention. And right now, he has not just stopped buying. He has been selling for 13 consecutive quarters. That is more than 3 years of sustained, deliberate exit from the stock market. The result sits on Berkshire's balance sheet like a flare. $397 billion, an amount larger than the GDP of most countries on Earth, larger than the combined cash holdings of Apple, Amazon, Alphabet, and Microsoft. And it keeps growing. So what is he seeing? The first clue is a number Buffett himself once called probably the best single measure of where valuations stand at any given moment. The Buffett Indicator. It compares the total market value of all US publicly traded stocks to the size of the US economy. Right now, that ratio has surpassed every prior peak in recorded history. At approximately 225%, it is roughly 2 standard deviations above its long-term trend. In plain English, the stock market is more expensive relative to the economy than it has ever been. Not since the dot-com bubble, not since 2008, not since any point in modern financial history. Buffett's rule has always been simple. Be fearful when others are greedy. And right now, by his own measure, the market is the most expensive it has ever been. The second clue is what he is doing with the cash. For the first time in years, cash itself, once again, generates meaningful returns. Those Treasury bills are currently earning between 3.6 and 3.8% annually. And when safe Treasury bills pay close to 4%, risky assets suddenly need to justify their prices. Because interest rates determine the cost of money itself. And when money becomes expensive, every asset on Earth gets repriced. That means Berkshire's cash pile is generating approximately $14 billion in interest income every year, without taking a single investment risk. The question is not whether Buffett can predict a crash. It is whether he believes the market is offering enough reward for the risks now being taken. And his answer, expressed not in words, but in $397 billion of inaction, appears to be no. The third clue is what happened in 2008. When the financial crisis hit and the world's banks were collapsing, Berkshire deployed billions at extraordinary terms into Goldman Sachs, General Electric, Bank of America. Not because Buffett is kind, because he had cash when nobody else did. And those who need cash desperately will give extraordinary terms to those who have it. As Buffett himself said, cash is like oxygen. You don't notice it until you don't have it. When markets panic, when prices collapse, when everyone else is forced to sell, Berkshire will have $397 billion ready to deploy. That is not a defensive position. That is a loaded weapon. The message from the world's greatest investor is quiet but clear. Nothing out there is worth buying at these prices. And this is what makes Buffett different from almost everyone else in markets. Most investors feel pressure to do something, to stay invested, to chase returns, to keep up with the market. Buffett is willing to sit still for years, because when markets finally break, liquidity becomes power, and those holding cash write the rules. Buffett stepped down as CEO of Berkshire at the end of 2025, after 6 decades. His successor, Greg Abel, is maintaining exactly the same strategy. The cash keeps growing. So what does this mean for you? It does not mean you should sell everything and wait. Buffett himself has repeatedly said ordinary investors should consistently buy low-cost index funds, regardless of market conditions. Dollar-cost averaging into broad market ETFs remains one of the most powerful strategies available to retail investors. But Buffett's cash position is a signal worth understanding. It tells you that valuations are stretched, that patience has value, that the best opportunities come when others are forced to sell, and that the most powerful tool in investing is not intelligence or information. It is the ability to wait. While markets celebrate, Warren Buffett is preparing. $397 billion. The world's greatest investor is waiting. The question is, what for? Subscribe to AxisShift, because the world is turning, and you should know which way.